For the introduction for the Standard Chartered Bank Standard Chartered Bank is a leading international banking group headquarters in London. It was formed in 1969 through the merger of a Standard Bank of the British, South Africa and a Chartered Bank of India, Australia and China. The bank also has a strong presence of Asia, Africa, and the Middle East and operating in over 60 markets globally. Most of the profit and the income come from the market is in Asia and Africa. The service of this bank offering is retail banking, corporate and institutional banking, wealth management, and Islamic banking. In Malaysia, the Standard Chartered Bank Malaysia Berhad is one of the oldest banks operating since 1875 and is regulated by the Bank Negara Malaysia (BNM). The bank is well known for its focus on emerging markets and commitment to the sustainable finance, strong corporate governance, and compliance culture. For the overview of the Standard Chartered Bank, name of the bank is the Standard Chartered Bank, and it is founded in 1969, merge of the Standard Bank and Chartered Bank, and the headquarters in the London, United Kingdom, presents over 60 countries in Asia, Africa, Middle East, and Europe, and it has employee 80,000 globally, and the key market of this bank is Hong Kong, Singapore, United Arab Emirates, and also Malaysia. For the business segment of this Standard Chartered Bank is the retail banking, which is individual banking, offering individual banking, credit cards, loans and savings, and also the corporate, commercial and institutional bank, which is services for companies including trade finance and capital markets, and also a private banking where it's offering wealth management for high net worth individuals. And for the core strength of this Standard Chartered Bank is it have a strong footprint in emerging markets, emphasize on sustainable finance and ESG goals, and also innovation.
Hi, my name is Nurada binti Muhammad Shairi. I will explain to you about the profitability. What is profitability? Profitability ratio are financial metric used to evaluate company ability to generate profit relative to its revenue, asset, equity, or other financial element. This ratio help investor analysis and management assess how efficiently a company is turning resources into a profit. Next slide. I will explain to you about the ratio in the profitability. Under the profitability ratio, number 1 is return on equity. As you can see in this chart, Standard Chartered in return on equity increased consistently from 2021 to 2024, going from 5.03% to 9.12%. This increased trend suggests that the bank became more adept at turning a profit, utilizing the equity owned by its shareholder. Strong financial performance, increased the profitability and efficient equity management during the 4-year period are all reflected in the steady growth in return on equity. Number 2 is return on asset. Standard Chartered return on asset increased consistently from 0.28% to 0.49% between 2021 and 2024. This shows that the bank ability to use its asset to create revenue improve over time, result in increased operational effectiveness and profitability. Next slide, I will explain to you about the spread and net interest margin ratio. Next is net interest margin from 2021 to 2023. Standard Chartered net interest margin improved, showing a strong earning from its interest-based activity. However, in 2024, the margin declined, such as a drop in efficient or higher costs. And the last one is spread ratio. Standard Chartered spread ratio improved dramatically between 2021 and 2024, going from 1.23% to a peak of 3.30% in 2023 before falling slightly to 3.27% in 2024. Stronger lending margin and better financial performance during a period highlight by this trend, which demonstrate that the bank became more efficient and produced net interest revenue from its asset. For this slide, I will explain to you about liquidity ratio. First is cash and short-term fund to total asset. The cash and short-term fund to total asset ratio for Standard Chartered varied between 2021 and 2024 after decline in 2022 and 2024 its peak in 2023. This demonstrates that the bank liquidity status fluctuates, with 2023 showing the highest availability of liquid asset in relation to total asset. Second is loan and advance to total asset. The loan and advance to total asset ratio declined steadily between 2021 and 2024. This implies the Standard Chartered may have been moving away from lending and towards other asset or revenue stream. Third is investment maturing in less than 1 year. Standard Chartered investment that mature in less than a year as a percentage of total asset and overall upward trend between 2021 and 2024. A minor decline in 2022, the ratio saw the substantial improvement in 2023 and continued to be strong in 2024. This implies that the bank's short-term liquidity position grow strong over time as it accumulates more assets that could be swiftly turned into cash to pay for urgent need to seize market opportunities. Lastly is a loan and advance to deposit. In 2021, Standard Chartered lent out 69.39% of its deposit as loan and advance. In 2022, the ratio slight increased to 69.60%, meaning the bank used a bit more its deposit from lending. In 2023, the ratio dropped to 66.73%, showing the bank became more cautious in lending. In 2024, the ratio fell slightly again to 66.26%, meaning even less of the deposit were used for a loan. For 2021 to 2024, Standard Chartered's loan to deposit ratio becomes slightly lower each year. This showed the bank was more careful with lending and chose to keep more deposit and loan possible to stay safe and liquid. That's all from me. Next, I will pass to the next presenter is Wan Abdul Rahman.
Hi, I am Wan Abdul Rahman. Now, let's take a look at the asset quality of Standard Chartered Bank Malaysia, Berhad. Over the past 4 years, the bank has maintained a healthy level of asset quality. Non-performing loans, or NPLs, have remained low due to strong risk management practices and robust credit assessment procedures. During the COVID-19 pandemic, government initiatives such as the PEMULI program and the repayment moratorium helped reduce the pressure on borrowers, which indirectly supported the performance of the bank's loan portfolio. Furthermore, the bank made adequate provisions for expected credit losses, reflecting a prudent approach in maintaining a resilient balance sheet. This demonstrates the bank's consistent ability to manage credit risk, even during uncertain economic times. Next, we examine the bank's capital adequacy position. As of 2021, Standard Chartered Bank Malaysia recorded a Common Equity Tier 1, or CET1 ratio of 13% and a total capital ratio of 17.9%. These figures are well above the minimum regulatory requirements set by Bank Negara Malaysia. This indicates a strong capital buffer, enabling the bank to absorb potential financial shocks and support business growth. A high capital adequacy ratio also enhances investor confidence and reflects the bank's commitment to financial stability and long-term sustainability. In short, the bank is in a strong capital position, ensuring its readiness to face future challenges. Next, I will pass to the next presenter.
Okay. Now, my name is Muhammad Hanafi bin Ahmad. My metric number 2024 794 361. This is my slide. I will briefly present the management soundness of Standard Chartered Bank Malaysia, focusing on its cost to ratio, income ratio (CIR) from 2021 to 2024. CIR shows how well a bank controls its cost. Right now, we can see the graph from 2021 to until 2024. The graph show how a bank controls its costs. Lower is better. In 2021, the CIR was 54.2% and it steadily improved to 45.6%. It shows a good signal, a strong sign of a better efficiency. During this time, income grew by 31%, while expenses only rose by 10%. So expenses like the wages of the staff or another things, and even slightly dropped from 2003 to 2024. This improvement is driven by digital innovation like mobile banking, apps, or another thing that will cut cost of the cost expenses. And cost control will tightly control, especially with fewer physical branches. So close branches, then just sum up with one center for one state. With a CIR under 50%, Standard Chartered is now among Malaysia's most efficient banks, showing strong management even during tough economic times. So next. In conclusion, Standard Chartered Bank Malaysia Berhad is strong and agile player in the Malaysian banking sector. The bank focuses on digital innovation, good governance, and client focusing to realize or feel good feedback. It's aiming to improve efficiency using AI, advanced technology, and provide excellent services to clients. These strategies help the bank stay strong and adaptable in changing market conditions like PKP or COVID-19. The financial ratio analysis gives more insight into its financial strength, efficiency, and overall progress. So we come out with this conclusion, and that's all from me. Thank you.